Welcome to Talk Tickers. Today we are digging into Nutrien's Q4 earnings, and wow, this is a fascinating one. You see, the initial headlines were all screaming miss, but the market's reaction by the end of the day, it told a completely different story. Let's break it down.
All right, so let's just jump right in. Right out of the gate, the headline numbers, well, they didn't look so hot. Nutrien missed on the bottom line. Adjusted earnings per share came in at 83 cents, but analysts were expecting 92 cents. That's a full 9 cents short, a miss of nearly 10%. That definitely got everyone's attention before the market even opened.
And it wasn't just earnings. The top line told a pretty similar story. Revenue also came in a little light. Now, the miss here was less than 1%, but still, you put those two misses together and the initial narrative for the day was looking pretty negative.
But this is where the story gets really interesting. Take a look at this chart. Despite that pre-market dip on what looked like bad news, the stock did a complete 180. It rallied all day to close up over 2%, and that reversal tells you everything you need to know. The market listened to the actual earnings call and heard a much more compelling story than what the headlines were reporting.
So what was that story? What did management say that completely turned the tide? Well, their message was actually pretty simple. Hey, ignore all the macro noise out there and focus on what we can control. This wasn't about making excuses, not at all. It was all about execution and simplification.
And they laid out this very focused three-part plan. It's all about number 1, operational discipline to keep spending in check, number 2, simplifying the business by getting rid of non-core assets, and number 3, a serious commitment to returning cash directly to shareholders.
And, this wasn't just corporate speak. They're backing it up with action. As part of that simplification strategy, they've already generated nearly $900 million from selling off assets that aren't central to their business, like the Profertil divestiture. They are actively streamlining their portfolio to focus on high-quality earnings.
They also put their money where their mouth is when it comes to rewarding shareholders. They went ahead and boosted the quarterly dividend to 55 cents. And this is a big one. They authorized a significant new buyback program to repurchase up to 5% of the company's shares. That's a real vote of confidence.
Okay, so with that strategy as the backdrop, let's look at what they're actually forecasting for the year ahead. This, my friends, is where the rubber meets the road.
So taking a peek at their guidance, they're projecting continued strength in their big retail business, with EBITDA expected to land somewhere between $1.75 and $1.95 billion. They see really robust potash volumes, and they're holding the line on capital spending, keeping it disciplined between $2 and $2.1 billion.
Now, it's really important to get this. Their entire forecast, all of it, hinges on one key assumption: a very strong market for their core product, potash. As the CFO put it, global demand is so strong it's actually starting to test the world's ability to even produce and ship the stuff. Just think about that for a second. And here's why they're so confident. They believe farmers all over the world simply have to replenish soil nutrients, especially after several huge crop seasons. So you combine that fundamental must-have need with the fact that inventories are super tight in key agricultural markets, and what do you get? A very strong demand setup for 2026.
Now, an optimistic outlook is one thing, but is it credible? In this case, yes. And that's because Nutrien has some serious, durable, competitive advantages. It's what we investors like to call a moat, and it lets them capitalize on these trends better than pretty much anyone else.
First and foremost, their cost structure is absolutely best in class. In 2025, they got their potash controllable cash cost down to just $58 a ton. I mean, that's not just low, it was actually below their own internal goal of $60.
So how do they pull that off? Well, a huge driver of that efficiency is their technological edge. Get this, almost half, 49%, of all their potash ore is now mined using automation. This isn't just great for safety, it's a critical reason they can keep those production costs so incredibly low.
So, let's put all the pieces together. We've dug through the headlines, we've looked at the new management strategy, and we've seen their competitive position. What does this actually mean for the stock going forward?
This is the key question for every single investor who tuned into that call. Do you buy the turnaround story, or do you stick with that headline miss?
Our take here at Talk Tickers is a market perform rating. And here's why. The narrative for this stock has officially shifted. It's not just a simple bet on commodity prices anymore. Nope, this is now an execution story. It's about creating a leaner, more focused company that generates higher quality earnings and cash flow.
We see the stock gradually grinding its way higher from here as those portfolio improvements and that strong potash market start to show up in the numbers. We think that will outweigh some of the lingering macro concerns like the challenging farmer economics down in Brazil.
This is not financial advice.